India's Defense Ministry recently published a 15-year strategic program by defense. Several $100 billion are likely to be spent on Indian defense. Let me again repeat it. Several hundred billions of dollars are likely to be spent in the next 15 years for our defense. And as a taxpayer, I feel that every single rupee I pay in taxes is totally worth it when I see the success like Operation Sindoor. But you know what? As an investor also, defense sector excites me a lot because there is going to be a huge money flowing into this sector for the next 15 years. And more importantly, as part of this roadmap, it is going to be a 360-degree modernization of our forces. All the three branches, Army, Navy and Air Force, they are going to get modernized in the next 15 years. For example, Army is going to get 1800 new tanks with UAV integration. Navy, for example, is going to get 10 next generation frigates, and each one of them might cost thousands of crores. For Air Force, 75 high altitude satellites will be procured. And these are just examples. You can read in this article what all the defense is going to procure. And if any country takes us for granted, they are going to regret it. But this video is not about wars and battles, but this video is all about stocks. I'm going to compare 4 to 5 stocks so that you understand which stocks in the defense sector has got good order book, which stocks have got good valuations, which stocks have got very good past track records, and the stocks that have not got past track records. This video is extremely important. It will make you understand all about the defense sector by comparing and contrasting these 4 to 5 stocks depending on how much of time we have. Before we start comparing stocks, a big shout out to the partners of this video, Odoo. Odoo is an all-in-one management software that offers a range of applications for entrepreneurs such as invoicing, accounting, project management, inventory, and much more. Beauty is that all these apps are brought onto one single platform, allowing them to communicate with each other seamlessly. One such app that you can get absolutely free for lifetime is CRM. Within the CRM app, you can track the customer opportunities in the form of cards with a Kanban view, and all the key information about your customer opportunities, for example, priority levels, their expected revenues, are all there in this Kanban view. By simply dragging these opportunity cards, you can move your customers from new to qualified to won. Within each customer opportunity, you can also plan events like meetings, mailings, callings, etc. All the customer conversations you can log as notes so that everything is centralized, ensuring simple and efficient management. Once you've logged a deal with your customers, you can create beautiful quotations and send to your customers in a few clicks, saving you time and efforts. And the best part, you have your first app absolutely free for lifetime. Check out Odoo today. The link is in the description and in the pinned comments. With that, let's start our discussion on the stocks. So the first stock that I'm going to discuss with you is BEML, which is Bharat Earth Movers Limited. It's a PSU. So 2-3 good points about this company that we need to understand. Then I will tell you the negative side of this company as well, so that you have totally unbiased commentary. First good point about this company is that if you look at the last 4 to 5 years and just focus on gross margin, EBITDA percentage, what you note very quickly is that back in 2021, the margin percentage was around 5.63. This has been consistently going up every single year. 7.40, 9.97, 11.98, 13.20%. And you know what? Management is saying that for FY26, this margin is likely to go further up, and it might be around 150 basis point. So this is currently at 13.20%. It might go to somewhere around 15%. So whenever a company's margin is expanding, what does it tell you? It tells you very simply that even if the top line of the company does not grow, their profitability will grow. Why? Because the margins are going to go up. It is a very good thing about a company's fundamentals if their margins are expanding, because then you're not worried about whether the top line is growing at a faster rate or not. But let's come to the top line as well. What is the management saying about top line? Their management is saying that we are likely to achieve 20% CAGR growth in the top line. And this, they are saying, is very much achievable. Now, whether this will result in 20% growth or not, I do not know. The management doesn't know, but that is what they're guiding for. And let me tell you that in the next few minutes, you will also see what is the growth projection for few other stocks so that you can compare and contrast. So in my view, these are very good stories about BEML. Also have a look at the order book. In the last 3 years, the order book has been consistently going up. It is at the end of FY25. was at around 14,000 crores. Now, very quickly, I see few negative points about BEML. Point number one is that if you look at this company's total revenue split, what you will note is that defense is contributing around 27% of sales only, mining and construction 54%, rail and metro 19%. So if you were to take a bet in a purely defense company, this company is not a pure play defense company. Please understand this. Now, whether it's a good point or bad point, if I'm looking at a pure play defense stock, then of course I do not like that, because tomorrow what happens if there is a risk or a slowdown coming from, let's say, rail and metro, if their projects get delayed? What happens if mining and construction all of a sudden hit some headwinds? I do not want that as an investor, because I'm looking for the defense stocks here. So in my view, that is a negative for this particular company. Second point that you will also note is the track record of the top line growth, which is the revenue growth. Last 3 years, if you note, the revenues have been very, very flat. 3899 in 22-23, 4054, 4022. So can the management really walk the talk for the next 20% of CAGR growth that they're talking about? Because the past track record is telling me that no, they haven't been able to grow their top line at a good growth rate. And the third point that I do not like as of now about this particular company is the valuations. If you look at the last 3 years of PE ratio, median PE has been around 53. Right now it is trading at around 56. So it's not that this company is available at a bargain price. If I look at the price to book ratio, for example, last 3 years it has been around 4.9, and right now it is at around 5.8. So one could argue that it's not available at a bargain price. Some may say that yes, 20% CAGR growth rate, if the management is able to hit, then that might become a very, very good case or good hypothesis from an investment perspective. But you know what? You cannot really invest in one particular company by looking at that company in silos. What you need to do is look at few other stocks in the defense sector. And that's what I'm now going to do. We're going to jump into few other PSU stocks as well as private stocks, so that we can compare these in terms of the top line growth, profit growth, order book, many other factors. So continue to watch this video, and I'm pretty sure you're going to continue to learn a lot. Let's now move to stock number 2, which is Bharat Dynamics Limited. It will be a very, very quick commentary for you. Why? Because there are few red flags that I see in this particular company. And the reason I'm still covering it, so that you can compare and contrast, right? It's very, very important that we compare and contrast, not just go blindly in one particular stock, right? So for example, here, what do you see? If you look at the financial highlights of this particular company for the last 5 years, what do you note here? Like, take 1 second and you can quickly see that, first of all, the revenue growth has not been there in the last 4 to 5 years. Secondly, it's been very, very lumpy as well, right? Look at the profit also. FY21 257 crore. Next year 499 crore. Again, next year 352 crore. Very, very lumpy PAT growth is what we are seeing here. Also look at the EBITDA margins, which is the brown color or orange color line here, the graph that you see. They're fluctuating a lot. The EBITDA margin in FY21 was 18%, moved to 25%. Again, dropped back to 16%, went up to 22%. Point is very, very simple. This is a very, very lumpy business that I see. And I personally do not like lumpy businesses. It is better to always invest in a company that is growing consistently. There has to be a consistency in the company. That's what I look for personally. I do not know about you, but here is some data that is telling us that in the last few years, there has been a very, very lumpiness in the revenues as well as profits. More importantly, if you go back to 10 years, 2015-16, the revenues were 4,000 crores. And in 24-25, still they are at 3,345 crores, meaning the revenue growth has not been there. One thing that is very, very positive about this company is that their current order book. So the order book as of FY25, end of March 2025, is 22,800 crore. So this order book is definitely better than the first company that we saw, BEML. But again, order books could be for a number of years. We do not know how much of this order book will get executed this year, next year, and so on. And also, the management has not done any con call in the 2025 year. At least I could not find any con call. And that does not tell me what is going on in this company in the last few weeks or months. And as an investor, I really would like that updated information. Otherwise, I do not invest in any companies. And on top, if you look at the valuations here, last 3 years, the PE ratio is at around almost 96 here. Median PE has been around 67. So this is trading well above the median PE or PB. Even if I look at the PB ratio, let's have a look at the PB ratio here. Median PB is 9.6 in the last 3 years. It is trading at around 13.6. So as an investor, I do not understand why the valuations are so high, while the profitability growth is not there, why the revenues are not growing at a very good growth rate. Yes, the order book is there. And also we don't understand how much of this order book will convert into revenues and PAT in the next 1 to 2 years. So therefore, This tells me that I'm not getting closer to this particular company. Again, not a recommendation for you, but hopefully this data about order book, their growth in the past few years will help you understand where do you need to place Bharat Dynamics into this defense sector. We have talked about two stocks so far, BEML and second is Bharat Dynamics. Let's now move to the third PSU, which is Bharat Electronics Limited, BEL. Bharat Electronics Limited, I've spoken about this particular company on our channel at least in 2 to 3 different videos, but I'll give you the latest and greatest right now. First thing is that around 90% of their revenues come from defense sector itself. So that is a very, very good figure if I want to invest in a defense sort of a company, right? Second point is that they have had a very, very good solid past track record. Have a look at the turnover in the last 5 years. Every single year, consistently, the revenues have gone up. Have a look at the order book. Almost every single year, except that FY25, their order book slightly dropped from 75,000 crore to 71,000 crore. But every single year that has been also growing if you just exclude FY25. Also from a revenue perspective, this is done 23,000 crores, which is almost 6 times than Bharat Dynamics Limited and BEML. So this is much larger and bigger company as compared to the previous two companies that we talked about. Also, more importantly, have a look at the EBITDA margin and PAT margin. You see the orange line here, what it is telling you is that EBITDA margin almost every single year except FY22 where it dropped slightly from 23% to 22%. But after that, every single year it has been growing up. Likewise, the PAT margins, if you see, from almost 15% to now it is reaching all-time high of 23% as of FY25. So definitely a consistently growing company if you look at the revenues, if you look at the profits. Now comes the order book, right? So what is the visibility when it comes to the future growth rate in terms of the top line and profitability? Have a look at my screen. You will see around 80,000 plus crore worth of order book. And they're expecting these large orders of QRSAM, which might add another 40,000 or 50,000 crores depending on when they get these orders. So huge order book. If you compare them again with the previous PSUs, this is almost 4 to 5 times bigger order. So this company is definitely a much bigger company. But if you talk about the revenue growth rate of this company in the future, what management is saying is around 16 to 17% of growth rate. For example, BEML, their management gave a guidance of around 20% CAGR growth rate. This company is giving only 16 to 17%. Again, we do not know which one is going to hit these targets, but from a growth rate perspective, this is slightly lower. Maybe the base is larger here, right? The revenues are 6 times larger than the BEML or Bharat Dynamics Limited. That's why you might see that the growth rate is not huge. But I just wanted you to be aware because we are doing the contrast and compare here in terms of the stocks. Last point about Bharat Electronics Limited is the valuations. If you look at the last 3 years PE ratio, median has been around 40. Right now it is trading at around 51. Slightly over the median ratios. If you look at the price to book ratio, again, median PB has been around 10. It is now trading at around 14. So one could argue that it is slightly overvalued from the median perspective, but for the order book that we are seeing 80,000 crores worth of order book as well as 40,000 crores order might come in the next few months. That is what potentially driving the higher valuation at the street for this particular company. Again, not a recommendation here, but I gave you these contrasts and compares so that you understand what is happening in the defense sector. So if you look at stock number 4, which is Hindustan Aeronautics Limited, HAL, what you will see very, very interesting about this particular company is that its PE ratio. If you compare this with other peers, you will find that this is a very, very attractive valuation, cheap valuation at around 36 PE as compared to 51, 96, 48, 67, 52 and whatnot. Now you may say that, Rahul, maybe because HAL is not a very, very good company. In fact, this is a very, very good quality company if you compare this with other PSUs. Few months back, around 5 months back, I did a total complete breakdown about this company's business model, highlighted why this company is a quality company, talking about its cash flows, talking about its order book, etc. And if you understand their business model, you are likely to appreciate this company much more. Again, I don't have time to cover all of this, but if you want to get such deep insights about any stocks, then you can consider joining my YouTube community. This community, almost on a daily basis, I am posting so that you understand what's happening in the market, and it will help you gain some insight and perspective so that you can make better investing decision. Feedback of this community has been excellent. Simply go to my channel, find the join button and be my guest. With that, let me now quickly give you few details about HAL so that at least you get what is happening with this company as of now. If you look at the order book of this company, it is now at 1,89,000 crores and previous year it was only 94,000 crores. So within a year, the order book of HAL has gone twice. This is a massive growth rate we are talking about, and we are talking about lakhs of crores here. This company, out of all other defense company, is sitting at the biggest order book. Secondly, the company is doing the capex around 14,000 to 15,000 crores. So company is expanding, which is always good news for investors. Now, please understand that just because the company is sitting at a very, very huge order book, it does not mean the company is going to grow their revenues by 20% or 30%. In fact, what their management is saying as of May 2025 is that their guidance is only 7 to 8% of top line growth. This is what you need to understand. We talked about other companies. They are likely to grow at a much faster rate versus HAL, which is again 7 to 8%. Again, might be the base effect here because this is much larger company as compared to other PSU companies. But I wanted you to be aware that don't expect a 20% of growth rate in their top line. Their management is saying 7 to 8%. Next year, maybe the management is saying is it might be in double growth rate, double digit growth rate, might be 12%, 13%, and so on and so forth. And also, if you look at the previous track record of this company, if you go and look at, let's say from COVID time period, and if you look at their sales data, you will see that from 21,000 crore to around 30,000 crores, hardly 7 to 8% of top line growth rate. But if you look at their PAT, which is around 2,800 crore to almost 8,000 crore, it's around 24% CAGR growth in the PATs. So again, HAL, if you are looking to invest in this particular company, please make sure you understand that they have a huge order book, but in terms of the top line growth, it is likely to be in high single digits, 7 to 8% of growth rate. Now, before I move to my last stock, which is going to be a private company, if you're so far liking this analysis, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Let's move to stock number 5, which is a private company called Data Patterns Limited. So Data Patterns India Limited is into electronics manufacturing for defense companies. Now, if you look at the company's past track record, very, very consistent company. For example, if you look at the revenues, they have grown at around 33% CAGR in the last 5 years, and every single year, actually every single year, the revenues have gone up. If you look at the profits as well, gross profits here, if you see, they have been going up every single year. So from a consistency perspective, full marks to Data Patterns India Limited. But right now, what is happening in this company, there is a one red flag that I can see right now, which is in Q1 FY26, it's not been a great quarter for them. For example, if you look at the EBITDA margins, they have been declining. It has gone down from 38% to 32%. If you look at the net profit margin, that also has declined. Last year it was 32%, it's come down to 29% and eventually 26%. So if a company's margins are contracting, then that is never a good sign. That's what I look at. We talked about previous companies. One of them was having margins going up consistently. That's a very good story. Here, the margins are coming under pressure. We need to dig deeper why that is happening. And the second negative thing that you need to note about this company is the order book. So if you look at the last few years, FY23, 24, the order book was very, very high. Almost 1,083 crores worth of order book. In FY25, the order book dropped. And in fact, if you look at the last 2 quarters, Q4 and Q1, the order book has not picked up in a great way. And that tells me that right now, if you ask me, Data Patterns India Limited, unless they get fresh orders, I think there is likely to be a pressure in this particular company. The moment they start to get fresh orders, then the company might do pretty well because there has been a consistent track record. So it really depends on what sort of orders they can get. Again, I do not know whether you're holding this company or not, but the current track record in the last couple of quarters that the company has been down in terms of their margins have been contracting and the orders are not coming. This is what we need to understand. Last point about this particular company is that the management is very, very bullish. They are projecting 20 to 20% of revenue growth rate in the next 2 to 3 years. So they seem to be very, very positive about this particular company, but please understand, this is a small company, smallest of the lot that we've discussed here, and 20 to 25% growth rate you would definitely expect from a smaller company versus a larger company. So you have to put that in this perspective. Let's also have a look at the valuations, what's happening in the valuations. So if I go to the charts here, last 3 years, median PE has been around 71, very, very high PE. Right now it is trading at around 67, slightly below the median. And you understand the reason of why it is trading below median PE, because you can see clearly that the Q1 has not been a very, very great quarter for them. So be cautious about this particular company. Have a look at the orders that they get, right? If you get a confidence about their orders, then only you can consider this company for investments. But if you don't see the order book increasing, then you might see that there are troubles ahead for this company, because again, 70 or 67 PE is not a small PE, you're paying 70 times more than the price, right? Remember that. So price to book, if you look at it, last 3 years have been around 10.7. Right now it is slightly below that, 9.6. But as I said, right now the order book is looking very, very low. Hence, there is a caution here. So this is about 5 stocks, but there are a few other stocks. For example, GRSC, right? For example, Cochin Shipyard, Mazgaon Dock, there are Zen Technologies. There are a few other stocks that I am not able to cover in this video. Video is getting longer. I keep seeing some comments on the channel that, your videos are getting longer. Try to cut them down. So maybe if you want me to cover any other defense stocks, let me know in the comments. I'm happy to create a part 2 of this particular video. If you want me to create it, I will do it. I hope you enjoyed this video. If you like this, request you again to hit the like button. Also, please make sure you subscribe to my channel, because if you subscribe, you are going to get notifications, and when you get the notifications, you will watch some good content which will help you making some good investing decision. With that, I hope to see you in my next video. Until then, keep rocking.